Good morning, everyone. I'm Meredith Laura Lear, Executive Vice President of the Chamber of Commerce, Southern New Jersey. On behalf of the Chamber, Flaster Greenberg, and Rutgers University Camden, it's my pleasure to welcome you to the Rutgers Business Outlook and thank you all for joining us. Let me also welcome our panel of experts and our moderator. Thank you all for taking the time from your busy schedules to address us this morning. The Chamber is extremely proud of our more than 20-year partnership to bring you the Outlook. Our joint venture has stood the test of time and speaks volumes to our collective commitment to provide timely, cutting-edge information to the business community. As you may already know, the Chamber has been more active than ever during the pandemic to make sure that the South Jersey business community at large has been represented in decisions being made at the state level and by offering substantive programming virtually to help our members stay connected and educated on the most timely issues. Since the start of the pandemic, we have offered nearly 275 virtual events with more than 20,000 viewers. If your company is not currently a member and you are interested in learning more about what our organization has to offer, please send me a message in the chat during the program. And now it's my pleasure to introduce Dr. Monica Adya, Dean and Professor of Management at Rutgers School of Business, Camden. Thank you, and join me in welcoming Dr. Adya.
Good morning, everyone. And I know Christina isn't here with us today. She's got important business, but I just wanted to give a shout out to her, wish her a happy birthday today. To all of you here today, thank you for joining us. As Dean of the School of Business at Rutgers University Camden, I am delighted to welcome you to our March Business Outlook event. This event is brought to you through a long-standing partnership between the Chamber of Commerce, Southern New Jersey, Flaster Greenberg, and Rutgers Camden. Exactly a year ago, the pandemic brought to a near standstill the steady economic progress that was occurring in South Jersey through multi-sector growth in higher education, real estate, energy, telecommunications, and tourism. Today, as a state and region are opening up, we are seeing positive indicators across industry, several industries, many of which are represented across our panelists today. So as we work together to recover from the pandemic, the Rutgers Camden School of Business is proud to be a partner in this revival. Our Small Business Development Center has provided crucial support to South Jersey entrepreneurs for leveraging grants and stimulus funding. During the pandemic itself, SBDC at Rutgers Camden has facilitated over $5 million in grants for local businesses and helped start 20 new ones and delivered over 325 consultations to the local businesses. Our executive education division is not only collaborating with corporate partners to develop and grow innovative leaders, but it is also working with government agencies to provide crucial workforce development and training. Rutgers Camden business faculty are delivering best practices in critical areas that strengthen our businesses, including remote work, managing healthcare supply chains, and building diversity and equity in the workforce. And finally, our students continue to show their scarlet spirit and resiliency as they prepare for a new norm in the world of work that we will see going forward. So now more than ever, Rutgers Camden is here to support our South Jersey public and private sector partners as you reimagine the future. Once again, welcome to the Rutgers Business Outlook. Meredith, it's over to you.
Thank you so much, Dr. Adya. Before I introduce our moderator for today's session, I would just like to cover a few housekeeping items. At the bottom of your audience console, you'll see the chat widget. You can use that chat widget to submit your questions for our speakers throughout the program. After their 4 presentations, we will have a 15-minute collective Q&A session, and we will get to as many of those questions as we can in the allotted time. An on-demand recording of today's session will be emailed to all attendees after we conclude today. So you'll have the opportunity to re-watch any portion of the presentation, and you can also share that recording with others in your company that might be interested. And now it's my pleasure to turn this morning's program over to today's moderator, Michelle Tarantino, Chair of Flaster Greenberg's Environmental and Real Estate Law Departments. where she concentrates her practice on sophisticated commercial real estate leasing, financing and acquisition matters, and has extensive experience in commercial real estate purchase and sale, financing, construction, development, and leasing matters throughout New Jersey, New York, and Pennsylvania. Michelle, the virtual floor is yours.
Thank you, Meredith. Again, I want to welcome everyone to the March 2021 Rutgers Business Outlook. It's great to see that so many people signed up and logged on to hear our industry experts today. On behalf of Flaster Greenberg, I would like to welcome each of you. Many of our firm's attorneys, which many of you may know, both live and work in South Jersey, and our firm, together with the Chamber, are honored to be sponsors of this Business Outlook for the past 22 years. As Meredith mentioned, I'm chair of Flaster Greenberg's Real Estate and Environmental Law Department. This is the first time I've moderated the Outlook, and I am happy to be joining all of you and our esteemed panelists today. For those of you who may not be familiar with our firm, we're a full-service commercial law firm. We are headquartered in Cherry Hill, and we serve clients across the entire state in the public, private, government, and nonprofit sectors. Our offices are throughout New Jersey. We also have offices in Pennsylvania, as well as Florida, New York, and Delaware. Our goal is to assist our clients in all stages of growth and development, from entrepreneurs and startups to established family businesses and large privately held or publicly traded companies. I would now like to welcome and thank each of our panelists from the economy, small business, residential real estate, and communication sectors for presenting today. We appreciate your participation on the panel. We look forward to hearing your perspectives and projections for these industries, as well as how COVID has impacted these industries and will continue to impact each of your sectors. Prior to today's program, each panelist was provided with a rating sheet to indicate how they feel about current business conditions, as well as expected future conditions. They were to give a rating, as well as whether they anticipated their businesses would improve, stay the same, or get worse over the next 6 months. Each panelist will talk about these scores and why. We will begin today's program with the economy sector. Representing the economy sector, we have Rhea Thomas. She's the senior economist in Wilmington Trust. She is responsible for monitoring and analyzing economic development in domestic and international economies for the investment committee and the firm, as well as communicating the economic outlook to internal and external audiences. Rhea, both myself and the audience are very interested in your feedback on the current economy in light of COVID and what you envision as the path forward. Many businesses across our region are still suffering from the shutdowns of 2020. You gave your industry a current business condition rating of D, but estimated will get better in the next 6 months. Can you please explain the reasoning behind your grade and your optimism?
Good morning, everyone. Hopefully you can all hear me. I'm happy to be here today, and thank you very much for having me. I hope all of you and your family and friends have been safe and healthy during the pandemic. It is kind of crazy that we've been in this situation for about a year. I do remember a point sometime during the summer when the weather was nice and we had had so much time on our hands because we were still on such a sort of strict lockdown, personally for our family, that I do remember my husband and I were looking at each other. We were like, we have all this time on our hands and we would love to go do something. My husband said he would like to go take a nap, and he told me to wake him up when the vaccine arrived. And it's crazy to think that we're now almost at that point. It seems like it's almost time to wake him up. And I think from the perspective of the overall economy, as Michelle mentioned, the current state of the economy is still, it's still in a pretty poor state. If you look at, where GDP is, we are still below pre-pandemic levels, but our outlook is more optimistic. And I'll try and highlight why we have that outlook. So to give you some context, gross domestic product, which is the value of all goods and services produced in the United States, is down roughly 2.4% relative to pre-pandemic levels, so relative to the fourth quarter of 2019. And in 2020, we saw the first annual contraction in growth in the economy since the financial crisis. It was a decline of about 3.5%. And that's compared to, at the height in 2009, a decline of 2.5% during the Great Financial Crisis. So quite a significant contraction. And if you go even further back, it was the largest annual decline in growth since 1946. So, the first contraction in quite some time and one of the largest in our, economic data history. Consumer spending, of course, which is the most important driver of GDP growth in our economy and accounts for roughly 70% of GDP, suffered drastically. And a large part of that, of course, was because of the fact that the service sector of the economy contracted and was shut down to a large extent. And services are a large portion of our spending typically, close to 70% of spending in the United States. The recession, of course, turned that a little bit upside down in the pandemic, and I'll talk a little bit about that later. And so the only parts of the economy that saw growth in 2020 was really government spending and the housing market, so the residential investment sector. So I could talk a little bit about that as well later. And then when you look at the labor market, which is really important for consumer spending, given that I had mentioned that 70% of spending in the United States or growth in the United States really comes from the consumer, the labor market, of course, is really important for that outlook because if you don't have an income, you can't spend it. And the number of jobs is still down by about 7% in the United States. We lost about 22 million jobs in the first 2 months of the pandemic. And that was nearly all of the jobs that had been created over the prior 10 years since the Great Recession. So quite a significant loss in jobs, and we've regained just over half of those. We're down by 7% in total number of jobs relative to pre-pandemic, and that means we still need to gain about 9.5 million jobs. So if you look at New Jersey, like the US on the whole, has seen heavy job losses in the service sector, particularly in industries like leisure and hospitality and education and healthcare. So in terms of New Jersey and its relative kind of performance compared to the United States as a whole, job losses at the height of the pandemic were more severe than in the overall United States. New Jersey saw a 20% decline in jobs in those first 2 months relative to a national decline of about 15% between February and April of 2020. Jobs are still down by about 8.2% as of December, compared to about 7% for the United States as a whole. And the unemployment rate remains elevated, about 7.7% relative to 6.2% for the United States as a whole. Some of the sectors that have again been hard hit are healthcare, which accounts for about 15% of jobs in the state, as well as government jobs, which account for about 14%. And many of the government jobs at the state and local level are related to education, which of course have been hit by the virtual schooling that children are undergoing right now. So that's kind of reduced the need particularly for staff at the schools. And then leisure and hospitality accounts for about 9% of jobs. And those jobs account for the largest share of job losses, both at the national level and the New Jersey level, about 30% since February, 30% of the total job losses since February. So, that kind of gives you some context for where we're coming from. Now, in terms of our outlook, we do think that we are nearing an inflection point here, especially as the weather gets warmer. And we have a number of factors coming together, in our view, 4 key factors that we think are going to drive a more optimistic outlook in the second half of the year. The first is falling COVID case counts. They have dropped off significantly since the post-holiday season. And then to add to that, we are getting the dissemination of the vaccine, and that pace is picking up rather notably. So we have about 20% of the population having received at least 1 dose of a vaccine, and we have approached close to 10% of the US population being fully vaccinated right now. So that's pretty good when you compare on an international basis. The US, overall the vaccine rollout has had some challenges, but relative to other countries, the United States is doing relatively well. So, those first 2 factors, falling case counts, and then you have, the acceleration of the vaccine distribution. And that will really be a game changer, especially when Johnson & Johnson's vaccine, which is a single dose, that could be a game changer because it will really accelerate that process. And then you've also had really easy monetary policy. So support coming from central banks has been unprecedented. It came very quickly. It stabilized markets at the start of the pandemic and has really remained in place. The Fed meeting is coming up this week. We expect them to continue to remain accommodative, which should support financial market conditions and keep lending conditions easy as well, which should be supportive for businesses. And then the last and one of the most important factors during this recession has been massive fiscal stimulus. So we had roughly $800 billion in fiscal stimulus during the financial crisis, and that the deployment of that fiscal stimulus coming from the government was much slower than it was during this recession. In this recession, we've had over $5 trillion in fiscal stimulus coming from the government. And so just the magnitude of stimulus coming out is just massively different than it was the last recession. And that's one of our more reasons for our more optimistic outlook, because we do think the deployment of that stimulus really has provided a bridge so far. It came out very quickly with the CARES Act and should continue to provide support going forward. If you think about the $2 trillion in stimulus that was just passed, that's close to the CARES Act $2.2 trillion that was passed at the height of the pandemic. So if you think about the amount of money that will be flowing into the economy, that does set itself up for a significant rebound in consumer spending, just as we expect vaccines and lower case counts to allow the service sector to reopen, as well as warmer weather. So those are the four key drivers that we think are going to come together to help consumers be able to spend the money that they have been saving, both from fiscal stimulus as well as the fact that they haven't been going out to dinner as much, or haven't been taking those vacations, or haven't been getting all of the haircuts that they normally do. That being said, there are some limits to the rebound in spending that you can do on services. So when the economy fully reopens and people become more comfortable, you may not go and get the 6 haircuts that you missed in between. You probably just go out and get one. But we do think that spending on vacations and travel will likely be higher as people kind of try and make up for lost time and get in as much of their recreational time as they can, especially while the vaccine immunity is still in place. And so those are kind of some of the key reasons why we are more optimistic. I'd say 2 themes that I'd highlight in this recession that have been different than past recessions is one, the difference in the goods versus services sector. Typically during recessions, you tend to see households scale back on their spending on big goods items, so things like cars or refrigerators, because people are worried about the outlook going forward. And of course, this pandemic, the nature of concerns about being in the proximity of other people has really actually caused the scaling back of the services sector. And so we do expect that as the economy reopens with vaccines, that there will be a reversal on that front. If you look at consumer spending on a whole, it's actually almost back to pre-pandemic levels, in part because of the fiscal stimulus that has allowed people to keep up their spending despite all of the job losses that we've had. Spending on goods has really more than made up for the lack of spending on services. So spending on services is down about 5% relative to spending on goods from pre-pandemic levels is up about 11%. So that's significant. It's basically masked the drop off in spending on services. And then the second trend I'll quickly highlight is housing. The housing market has done extraordinarily well. It is well above pre-pandemic levels of activity. And that's, of course, because the pandemic has spurred a growth in activity, as people have wanted to move into less dense spaces and create more space for their home offices, for their gyms. And so that has been an aspect that has been unique and in stark contrast to the financial crisis. And then I'll just highlight to close out, because I know I'm just about at time now, 3 key risks that we see to our outlook going forward is any developments on, slowdowns in the vaccine deployment or complications with the rise of variants that the vaccines are unable to handle. That is a risk to our outlook. Of course, the virus will remain in the driver's seat of this recovery. And then the 2 other factors to look out for would be, a faster than expected pickup in inflation or higher taxes, which we do think might be coming down the pike in the latter part of the year. And that's something we would watch out for as well in terms of corporate taxes or personal income taxes. But those personal ones would likely be at the higher end of the income spectrum. So I'll close it out there, and I'm happy to take any questions at the end.
Thank you, Ria. At this point, I want to remind everyone in the audience that any questions for Ria or any of our panelists today should be submitted to the chat and will be discussed during the question and answer session at the end of the program. We're going to now move on to the small business sector. Representing the small business sector, we have Kelly Brosma, State Director and Chief Executive Officer of the New Jersey Small Business Development Center. Kelly is committed to guiding established small business owners and aspiring entrepreneurs in creating and expanding their business enterprises. Such growth and expansion are critical to sustainable growth, job creation, and economic development and prosperity in our area. Kelly, you gave your sector a C rating, but you also estimate that business conditions will get better within the next 6 months. Kelly, we're looking forward to your views on the impact the current economy has had on small business and your outlook for the future.
Great. Thank you for having me, and good morning, everybody. It is an exciting time in the sense that we have some positive outlooks. It was great to hear on the economy and the economists on what we have to look forward to. Before I get into sort of why I gave a C rating and I have a positive outlook of things getting better, I want to explain a little bit about the New Jersey Small Business Development Center Network. So we are a public-private partnership. We are hosted by Rutgers Business School, which covers the entire state. We have 12 centers that cover every single county. We provide no-cost consulting and low-cost and no-cost training events and webinars right now. Right now, during COVID, we're not charging for the majority of our webinars, so please take advantage of it now because we want to make sure that we're giving back to the businesses on anything from starting to growing to staying to, unfortunately, in some cases, exiting. We want to help you in whatever section you are in your lifespan of your business, but know that there's help here and that it is at no cost to you, especially the one-on-one consulting. We get funding from the SBA. We get funding from Rutgers Business School. We get funding from our 12 hosts, and we also get funding from the BAC, which is the Business Action Center. And we partner with NJEDA as well as other organizations across the state to make sure that we're providing relevant information in consulting and skill sets that you really need to grow your business. So one of the things that I wanted to talk about this morning is to talk about the businesses and some of the things that people are hearing. And unfortunately, sometimes when you hear things in the media and people get a little bit down on how things are really playing out, the reality is that the SBDC is there in times, troubling times. We are more relevant when we're needed the most in a down economy, or especially, unfortunately, during COVID, in disasters, and COVID pretty much is a disaster. We're actually working overtime to make sure that we're providing relevant information, relevant skill sets of our consulting and training programs. So there's an article that was out there about how women entrepreneurs and businesses are declining because women are moving back and unfortunately with daycare and situations that they have to take care more of the home front versus their businesses. Well, in the SBDC world, I'm excited to say that not only are our women entrepreneurs growing in our sector and that we're working with, but also women minority owners are skyrocketing for us. So I just wanted to make sure that sometimes people hear these articles are out there. It's not all doom and gloom. There are really rays of sunshine through all of this. And we want to be that bridge to that sunshine and the good outlook for you. So some of the things that we've put in place to make sure that we're helping businesses to stay on top of things is topics that are relevant to today, not what was needed a year ago, but's relevant today. And one of the biggest things that people need is financing. So there's a lot of grants that were coming out, PPP, EIDL, and a new grant that's coming out to be announced called the Shuttered Grant, which is helping, and I call it the creative industry, arts, culture, and outdoor venues. So we want to make sure that we're providing consulting and training programs to make sure people get ready. How did we do that? We created what's called a capital team to specifically help businesses in accessing capital. Now, not all of it's going to be grants, but there are loans that are available and we can help with any type of financing needs. And again, we don't lend it, we assist you in the process of finding and reaching out to what organizations are lending, what grants are out there, and also how we can help you in your pathway to success in not only staying business, but to grow in business. COVID has been hit pretty hard, especially on the restaurant and the service industry. Right now, we've partnered with NJBIA, which is the Business Industry Association, to put healthy business certification programs together. So again, staying on top of things. What does that mean? It's a one-day session that we will cover the cost for participants to go through. That's normally a $400 value. And on top of that, you get an 800 number that you can access any questions, Q&A with Meridian Health. And so they're going to answer questions, and you'll get that 800 number for a year. And that's a $1,500 value. And we are going to be covering that during the COVID. We'll do 3 sessions. So stay tuned for that. And I'm going to say njspdc.com is where you want to go to our website to find all of this information. So some of the other things I just wanted to make sure that we mention is any daily activities that businesses are needing, how to stay in business, what their financial outlook, media, marketing. We're helping a lot of businesses with what is the right platform to be on, what technology platform. And if you're a brick and mortar business and you need to stay relevant, let's help you with getting on that platform, whatever your website might be, or Zoom or LinkedIn or whatever it may be. We can help you and assist you in that process. And again, we have skills from CPAs, we have attorneys, we have experts in all the different industries. We are targeting service, we are targeting medical, and we are targeting creatives in the art community just because they're hit really, really hard. But that means construction industry we're covering. And we just did a partnership with Turner Construction on helping people to become a primary vendor for them. So we have a lot of stuff that's going on. We are here to help you. And again, it's no cost consulting that goes through. And you know, SBA money is taxpayer dollars. You've already paid for this service. So we would like to be there to help you. And I certainly want everybody to know that there is help there. Even if you need to just bounce ideas off of a consultant, we can be there for you. So just know we can be your lifeline. We can be your one call that you need to help you. And if we are not the be all end all, we partner with a lot of organizations. So just know that we can be that conduit for you to get you to the right resource as well. So know that we're here. And again, njsbdc.com. Go there and you can find us listed on consulting and our webinars that are listing and whatever we can do to help you to get you to the right resource. So I really want to thank you all for letting me speak today and announce all the great things that the SBDC is doing to help. And we're here to help you. You're not alone. So thank you.
Thank you, Kelly. Next, we turn to the residential real estate sector. Representing the residential real estate sector in the area of title insurance, we have Keith Lange, Principal and Executive Vice President, Surety Title Company, LLC. Keith has over 20 years of title industry experience, specializing in sales, refinances, commercial property transactions, and large developer and builder out sales. Keith, you are the only panelist today to give your sector an A rating, and you estimate that business conditions will stay the same over the next 6 months. We look forward to hearing from you on the current trends, challenges, and opportunities in the residential real estate market, as well as where you see this market heading.
Thank you, Michelle. Thank you to Stephanie and Meredith and the entire Rutgers board. Also to be on the panel with Rhea, Kelly, and Joseph, and also Dr. Monica Adai. It's a pleasure to be on here today. First, I'll just give a little bit of short background, 1 or 2 minutes of just my history and surety title. We'll talk a little bit local, nationally on the real estate market locally, and then we'll touch on the commercial end. I gave an A because of, if everybody's paid attention to this market, it has boomed since COVID has taken hold of us about a year ago, and the market then since June of last year has taken has skyrocketed. So we'll touch on that, and that's the reason for my A. And so far we still have been very busy. I don't know if we're crazy busy, but we're still busy. So as of right now, I'll give the same. My background, I was Michelle said, I've been in business 25 years in the title business. I grew up locally, going to the Shawnee High School, and then over to the University of Delaware, staying local. And I like to say I was recruited into this business by a friend of mine's father, Joe Ryan, who's still in the title business after 65 years, recruited me off the football field into the title business world. So I don't know if I can blame him or not. And I'm no Joe Flacco, so I'm glad I'm in the title business where I am now. Surety Title has been around for 29 years. Today is actually its 29th anniversary. If you see on social media, we'll have some posts out there later today. We handle residential, commercial, national foreclosures, REO business. We also have a refi business that handles refis across the country. We also have an affiliated business partnership agreement with certain companies. So we are a full marketing, technology, innovation, title insurance company, and we focus on realtors, builders, attorneys, accountants, bankers, and even direct consumers. Anybody that is associated with the real estate, we connect with. And our goal is to give service, knowledge, and give a smile, and make sure we can satisfy every person buying their first home. The real estate market nationally, the current real estate market has been as robust as it's been since 2003 through 2006. Rates are still at an all-time low. They were about 3% before the COVID hit about this time last year. They trickled down to about 2.5% on 30-year fixed mortgages in the fall and also into this winter. The forecast would be rates would be going up in the next 3 to 6 months, maybe to about 3.5%. I don't think it's going to go much higher through the rest of the year, but that kind of gets us to that why we're still in the same A+ category of the market. People are still refinancing. Rates are still at an all-time low. The Mortgage Bankers Association does predict that we will have an increase in the rates, and I don't think we're going to get to 5% by year end, but I think if we said 3.5% up to 4%, as long as it doesn't affect the growth in our economy, I think the rates will have to continue. One of the problems that we have right now in the industry of the real estate market and everybody that's looking for a home is there's bidding wars. We're having bidding wars. There's 20, 30 bids on certain homes. And that has caused an issue within the market. When we were not able to list homes because of COVID last April and May, the outpouring of listings that took place over the summer pushed our spring market into our end of summer and in the fall and into wintertime. And in that respect, pushed everybody that can sell a house, everybody was buying, and now we have a shortage of listings. One statistic down the shore is last year at this time in Stone Harbor, Avalon, there was 192 listings. They're down to 64. So there's not just the overall market is short on listings, and we're trying to find a way for that. And that's across the country. Just give you some stats. In 2020, the value of the U.S. housing market was about $36 trillion, and it was up about 7.5% to 8% from the previous year. So, and of that, 4.3 trillion was in mortgages, and about 2.8 trillion of that was in refinances. So we saw an increase of the overall market in real estate from 2019 to 2020. We also had the highest existing new home sales pace since 2006. So 15 years later we're at that boom that we had in 2005 and 6 of new home sales. New home sales also comprise of about 15% of the overall U.S. home sales from economic terms in job creation, investment activity, and economic production. So a lot of that was builders, new construction. They had the lull from March and April and May because they didn't know where the market was going to go. And then they had a huge increase of job creation, job fulfillments back into the market to build homes for existing people. What we've also seen nationally is because of COVID, a lot of suburban cities have moved to suburban markets, and a lot of suburban markets have bought second homes down the shore. We've also seen less travel. So with the travel, people are looking to buy that second home, stay in their house, refinance their house, pull out cash, and do office space at home, do a gym. I think Rhea touched on that. So that has been the reason for not as many listings. And when something does come up, people are pulling cash out of the stock market and buying that second home, thinking, I'm not going to be traveling as much anymore. I want to have that other home. And locally in our market, we've seen about a 25% increase in this market. The region has boomed. We've had like I talked earlier, bidding wars. The shore market is still extremely hot. It's almost unpriceable to buy something right now because of the market. People are reinventing themselves at home, working from home, and I think that's going to be a trend that's going to continue. And that kind of leads into our commercial market, which are two trends: that the multifamily, where people still, if they've moved home and they're with their parents, they want to get back out. So the rental market is still there. Others are saying, if I had a 2-bedroom, I need a 3-bedroom now. So everybody wants more space because they're trying to make an office part of their house. And also the rentals have increased, and also with that is the industrial market. So with industrial, we've seen the online shopper, which that was pretty active before COVID. And I would say since COVID, the online is become more active. I know I come home every day and I'm thinking everybody on this phone, I'll see boxes of cereal from Target. I'll see just a shirt that my wife will order. So where she was I call her A+ shopper, now that online shopper is coming right to the house. So in industrial, that you'll see more Amazon space and more that large cold storage for sending cold food. So the multifamily industrial are going to continue to increase. The worry is office space. Who's going back to the office? Will that still be space that people want? Will they want as much, especially probably in the large cities? And then also retail. How many people are going to go to shopping as much, spend the time to go to shopping? Obviously, the big concern is malls. So we'll see. We'll come back with malls. So, to close, I think my time's probably pretty close. Just like we're obviously I gave a grade A. I think the market will continue for the next 6 months. What I would forecast in 2022 would be a little bit of a slowdown because of the listings. People have already refinanced. I think the rates will go up a little bit, and we'll probably see a little bit of a stagnant 2022. But for the next 6 months, we look very optimistic.
Thank you, Keith. At this
Thank you.
point, I want to again remind the audience that any questions for Keith or any of the other panelists today should be submitted to the chat and will be discussed during the question and answer session at the end of the program. Closing out today's program, we will hear from the communication sector. Representing the communication sector, we have Joseph Divis, Interim President of AT&T New Jersey. Joseph leads AT&T's legislative, public policy, and philanthropic initiatives in New Jersey, where he works with elected and appointed officials in business, community, and civic leaders. He's a 25-year veteran of AT&T and its predecessor companies, and maintains a portfolio of external affair responsibilities for AT&T in Pennsylvania and Delaware. Joe, you gave your industry a current rating of B, and you believe the conditions will improve within the next 6 months. Can you please explain the reasoning behind your grade and optimism, as well as update us on the impacts of COVID and government regulations on your sector?
Good morning, everyone, and thank you very much to the Chamber for inviting me, and thanks to our sponsors, Rutgers, Camden, and Flaster Greenberg. It's great to be here. As we talked, where we've been is part of where we're going. As has been mentioned, COVID has been the story of our life, and for our industry, the pandemic really only served to heighten just how important connectivity and robust connectivity is to our communities and our quality of life. We found our nation's broadband networks overall performed admirably. CTIA, which is the Wireless Trade Association, suggested, and I completely agree with it, that COVID was the ultimate stress test for our networks. If we look at how our lives and what we had to do from a digital or virtual perspective, just like this meeting. Wireless networks handled an unprecedented surge in mobile traffic. Voice traffic jumped 40%, data traffic grew nearly 20%, and wireless network speeds actually increased. For AT&T alone, in a May 6 article in The Atlantic, noted that as a result of COVID-19, in just a few weeks, AT&T accommodated more new traffic every day than its total daily traffic of 6 years ago. Our network access VPN, our customer connections there jumped roughly 700% in the first few weeks of the work from home paradigm that we all faced. Growth of network traffic that we saw in 2020 was on top of an already accelerated trend. Mobile data traffic on our national wireless network increased more than 661,000% since 2007. So think about that. We know New Jersey has its share of traffic issues, but just think if traffic increased on a scale like that. And you may recall that 2007 was the year the iPhone launched. So when we had COVID, it was just really on top of what was already a pretty profound trend in increasing data traffic. We also believe that the impact of COVID will, likely have very long-lasting implications for how enterprises operate, as we heard earlier, how people congregate, how they work, how they travel, how they interact. And as a result, we're having to align our business, how we work, to continue to adapt to the reshaping of customer behaviors and to the economy. We have 50 store locations in Southern New Jersey, a mix of company-owned and authorized retail. And so we've certainly had to adjust how we have worked to serve customers, whether it's curbside service or other things. There's been a lot more digital and online shopping that people have taken part, as I think Keith mentioned, with some of the shopping, some of the things he finds on his porch every day. So, what's next? I would say there's going to be even more desire for connectivity and broadband and bandwidth. Some companies are going to remain 100% remote post-pandemic. Others, like ours, we're going to take a hybrid approach where it's going to be flexible for some employees. Some, like myself, I will not have an office going forward, and others obviously will have some office. And we expect the enterprise to continue to evolve its connectivity demands. Remote will continue to be a big thing, and the need for security across locations and platforms. We've seen a market jump in telemedicine and virtual office visits. My wife has had a number of those. Doctors are sometimes doing those exclusively while we're still in the pandemic. And connectivity is going to continue to play a vital role in our quality of life. We've seen streaming and gaming will continue to grow. Streaming has increased significantly, as you might imagine. New Jersey, I can tell you, is in the top sector of how much streaming they purchase on a monthly basis, $49.57. Which is number 7 in the country. The national average is $48.23. So Jersey has a lot to be proud of in how we're making sure we're entertained and using some other time when we're not working, when we're not virtual, and that split between work and home, we have to demarcate a little better. But it all leads back to, for us, continued investment in our infrastructure and in capacity. For broadband service, you're going to see continued investment in spectrum. The FCC just had what they call C-band auction that our company and others were significant participants in, and moving towards the continued evolution of 5G connectivity and services on the wireless side. And you're going to see that continued expansion of 5G in many ways. For us, it's both our sub-6 spectrum, which is the low band spectrum, and our millimeter wave spectrum bands that will provide a great mix of speeds and latency and coverage for our consumers. Physical infrastructure will continue, again, to be a big part of what we do. We have a lot of projects that are squared up and ready to go in South Jersey over the next several years. With our macro and small cell development, because in addition to the spectrum that we get, the infrastructure is critically important to our ability to densify the networks and run capacity needs that our customers are demanding. If you think about our networks, macro facilities and spectrum are the highways, and our small cells are the off-ramps. So it really does go hand in hand that we need that infrastructure and the spectrum and our wonderful engineers to continue to meet the demands of whether it's customers, whether it's good consumers, businesses, healthcare, education. All of those sectors depend on robust connectivity. On the policy side, there's legislation in Trenton that would provide a consistent and predictable path for our small cell deployment across the state's 500 municipalities, and a common thread of regulation that's been a little bit bumpy for us as we pursue those projects. But we think that the Assembly bill, which is A1116, ties into the state's economic development strategy to help businesses recover post-pandemic and to support jobs and education and keep our state and our communities in this region competitive. And we also saw, as a result of the pandemic, the digital divide and the fact that access and affordability for broadband came to the forefront in a manner of speaking. So you're seeing some things at the federal level with, say, the emergency broadband program out of some of the relief efforts that the Congress and the administration have passed, which will provide some subsidies for low-income consumers. We are going to be participating in that program. And then the other one that we're looking at as a real advocacy point is the modernization of the Lifeline program, which was started many years ago as a subsidy for voice services. And we know that while voice services are important, it really is data, broadband, and that kind of accessibility to whether it's distance learning, whether it's signing up for your vaccination. That type of connectivity is so important. So the Lifeline program, we think, needs to be modernized and updated to support broadband services, and that should have a sustainable funding for the long term, and that Congress needs to be working on that. So those are some of the things that we've seen both during the pandemic and what we're looking at going forward. And I think I'm probably right at my time.
Thank you, Joseph. We're now going to finish up our program with a question and answer session based on the questions submitted into the chat. I'm going to start with our first question. I'm going to direct this one to Ria. And this question came in, and it is as follows. We were informed at a recent company briefing that the United States has entered a recession. Does our local economy have a bubble that will burst or has popped? And are we less susceptible as a region to national economic impacts?
Yes, it's a good question. I think this particular recession has been different, particularly when you compare it to the Great Recession, in that it wasn't induced by sort of some type of internal economic bubble. Unlike many of actually the past recessions that we've suffered from. The Great Recession, we did have this debt buildup on the consumer side that was built upon the housing market bubble. So there were kind of multiple bubbles that had to work themselves off after that bubble burst, those bubbles burst. And so the Great Recession was kind of a long recovery period. In this case, we sort of had this external force, the pandemic, coming and hitting the global economy, basically out of nowhere. And it wasn't something that, had been generated from an economic source. And so from that perspective, there hadn't really been too many bubbles that had built up in the last recession. I think the one, probably most notable one that continues to be something that we monitor is, the corporate credit or, corporate debt. There's sort of a building trend that we are watching there, and that does remain susceptible. But given that interest rates remain low, that is something that, should remain in check for now, but that's something we continue to monitor. And the Fed really did come in and their actions were able to stave off a corporate credit crisis as a result of that debt buildup that had existed pre-pandemic as well. That corporate debt, those corporate debt levels have climbed even further since then because of low interest rates. But again, it's something we're monitoring, and right now interest rates remain still low, even despite the recent pickup. I'd say in terms of other kind of thinking about bubbles, one way to think about a bubble is also sort of if there's excess capacity. And so one thing that we are thinking about is particularly in the travel industry, on the consumer side or the personal travel side, we do think that demand is going to rebound back to pre-pandemic levels. And that will happen faster than it will on the business travel side, as we've had a number of panelists talking about, the fact that some of us may not be returning to the office. And that may create a little bit of a bubble from that perspective, in that some of the existing capacity to meet the needs of business travelers, those might be unneeded going forward. And that's sort of an inverse bubble. Is not, if that demand doesn't fully return, that could be an area to watch out for going forward. But on the personal sort of tourism, leisure side, we do expect that once health concerns die down, for the most part, that type of travel should return. So I'd say one area to watch out for is really kind of the business travel industry, where you might have a little bit of excess capacity there, and of course anything related to return to work in office.
In terms of a follow-up, we had another question that asked not about the business travel industry, but the tourism industry in South Jersey, and what you saw as the forecast for that in the next 6 months.
Sure. Well, I cover the national economy, so we don't have forecasts at the New Jersey state level per se. But again, I think in line with this idea that personal travel we do expect to come back, because I think that households and families, they really need to get out and they want to get out. We do think that there may be some underlying concerns from a certain segment of the population, perhaps, that is still concerned about health reasons. But I think, in a year's time, assuming that all goes well with the vaccines and the variants, that should return. And so on the personal side, we do expect a stronger return there than on the business side.
I can just maybe add, I was speaking to one of my small business leaders today. I'll give a shout out to Ariel Gallo, my colleague who serves a lot of small business in South Jersey, and she's been having conversations with folks at the shore points, and I think they're really they think there's a pent-up demand for people to get out and enjoy the recreation that our shore towns have provided. We have invested part of our network in making sure that on the boardwalk and where people are taking pictures and taking video and doing all that stuff, that we can make sure that their connectivity is there as they're enjoying that family time. So I think there's a real hope that that we're going to come back to something with as the evolution of the restrictions move along. And like I said, we will continue to invest, because at some point people are going to be going back down there.
And if I can add just to that as well, one of the, am I muted? One of the most important things is the confusion of whether businesses are open or not. So putting together a marketing plan on how to get the word out that you're open for business is really key. And just know that, again, we have consultants that have expertise in the marketing area that can actually help with each of the businesses to let the consumers and the general population know that they're open for business.
Really, while I have you, we also have some questions in your area. Let's start with, I think you mentioned during your program, but is there a cost for consulting or training for the small businesses that contact you?
No, all of our consulting is at no cost, and it always is at no cost. And majority of the webinars and the training that are going on at no cost during COVID. So pretty much we're the best price in town. So I don't like using the word free, because nothing is ever really free, but yeah, we're a good price right now.
Okay. And how would a potential business know if they would be qualified to receive grants or funding that are available?
So we would sit down with them. So we have experts that understand all of the grants and the parameters of the expectations of what they're looking for. So all it takes is for anybody to sign up to be a client of ours, again, at no cost. And we can go through their business and whether they're eligible or not. If they're not eligible for any of these particular grants, there's also other funding that's available to them. So we could help them be a matchmaker to get them to the right resource.
Thank you. This question came in for no particular panelist. In what ways do you think the U.S. government will be paying for the stimulus packages?
Are we talking just confusion, the stimulus packages of the relief that each individual is going, or I guess a little clarity on exactly what they're asking would be helpful.
Yeah, I think they meant the U.S. government stimulus packages that have gone out to businesses. You know, the CARES Act and funding and other. And Rhea, if you could maybe speak to that.
Sure. I can speak to it at, kind of a broad-based level. We do think that some of this will, in terms of the economic picture, this is kind of a risk that we do watch out for in the future. And typically, when we take on more debt, we eventually do have to pay for it, either with higher taxes or, lower economic growth because of those higher taxes and those types of things. And so we do expect with the Biden agenda going forward, he has, during his presidential campaign, he, did propose income taxes, higher income taxes on high income households, as well as a potential rise in the corporate tax rate. And you've actually seen this in the UK, for example, as well. They've actually planned a corporate tax increase, I believe, from 19 to maybe 25%, starting, I believe, in 2023. So this is something that will happen likely not just in the US, but internationally, because many of these governments have put in place pretty generous fiscal stimulus packages, but we will end up having to pay for these going forward.
Thank you. Next question is for Keith. Keith, could you let us know what you see as the biggest challenges in the real estate market going forward?
Going forward is the way we handle closings. I guess if anybody has bought a house during the COVID times where we used to have buyers and sellers and everybody come to our office in this region, we now have sellers signing docs ahead of time. We have just buyers coming in. It's not the excitement of buying a home. So our challenges are, how are we going to get more, more of like a DocuSign, or what they call now in our businesses a RON, a remote online notarization, or RIN, remote ink notarization, and how can we do closings without having to come to a title office or real estate office and do the closing, where we can do them almost via Zoom and sign documents remote and online. So that's a challenge that we have ahead, and I think COVID has pushed that to the forefront of changing the way that real estate closings and real estate in general is going to adapt to.
Thank you, Keith. Next question, again, for no particular panelist, is how much do you think the South Jersey economy has permanently been changed by the work from home environment that COVID has created?
Less traffic.
That's a profound question on a lot of levels, and Ralph, I think if anybody knew that, really knew, but I think we're in the middle of it, and with work from home, and I know for us, how does that continue to move the traffic patterns that we've historically dealt with, and what the demand is for workers when they are working from home for connectivity purposes. So I think as Keith mentioned, in the corporate real estate and things like that, I think we're all going through it, and boy, oh boy, maybe we should all get together. Meredith, get us all together a year from now, or 18 months from now. We'll see how we can answer Ralph's question, huh?
Yeah. Well, and on the small business side of things, it's been very interesting because it's always been toyed of, can we work from home and can be effective, and can we be productive being working from home? And this has been, quite honestly, a petri dish of research on what is working, and what it's shown is that we can be as effective. So how will it affect the the economy in the sense that you can do a lot of business now, from home as opposed to having physical locations. So in one way, it's going to save businesses a lot of money, right? Because they don't have to have the overhead of a location and a space. But on the other side, people still want to get out and they want to physically look at things. So what I see in the small business world is moving forward, everybody has to look as a hybrid. Of a hybrid, you definitely need to have that online platform. You definitely have to have that presence to stay relevant. But people want the physical to be able to look at stuff and touch stuff. And it's good for our mental health as well to just get out, on top of it and go view things. So what I see moving forward is that all businesses really have to pivot and really have that hybrid of both the online as well as the brick and mortar. And what does that brick and mortar look like, right? Do you really need the office space anymore? But there's still going to be space needed for meetings and things like that. So moving forward as a hybrid is really what we see forecasting is going to be the wave of the future.
Next question in the chat.
Ria's trying to speak, I think.
Oh,
Ria.
Sorry, I had double muted myself, but we can move on to the next question if
Okay.
you're already started.
no.
I'll just add quickly. I mean, I think in terms of broader trends in the economy, and I think this, applies to South Jersey, but also more broadly, if we're not going out to our offices, we typically stop at physical retail stores, on our way back, that type of thing. And, if we are working more from home, we may be more apt to just say, you know what, I don't want to leave my house today. I'm going to, click and buy something, online, and that might support, in terms of jobs in New Jersey generally, trade, transportation, those areas do tend to have strength in New Jersey. That might support some further, the warehousing side of things as well. And then I'd say, it may also decrease demand for, some restaurant workers and those types of businesses that do cater to office workers. And so there are sort of, potential upsides in terms of jobs, but there are also potential downsides. So it will be a balance. And as everyone is saying, this is sort of an experiment. And it'll be interesting to see kind of where we land at the end of all of this.
Thank you. Next question would be, what happens to your predictions if we undergo a third wave as a result of government action or the new strains?
I'll just, from an AT&T standpoint, I think our industry, we invested well before the pandemic, and because once that hit, you weren't going to build the infrastructure needed, and I think we're going to continue, to do that. We did, I think in New Jersey, it was $1.3 billion on our wireless and wired networks between 2017 and 2019. So for us, we're going to continue to make that investment in our infrastructure and our connectivity, because whether it improves or we go back a step, that's going to continue to be an essential part of how we exist in our quality of life and our commercial success.
On the small business sides of things, quite honestly, I think the businesses are being a year into this already. They're very well prepared for any future new waves that are coming out, and way more than it was a year ago. And so I do think that businesses, any entrepreneur, the definition of an entrepreneur, I won't get in there, but they have to be prepared, and you have to, plan for the worst and hope for the best, unfortunately. And I think right now, with all that's gone on in the last year of experiencing this, I think businesses are well placed and well prepared for any future waves that are coming out. And hopefully that won't happen, and hopefully we can go back to whatever the new norm will be. But they're prepared now, and so I think that it's not going to be as daunting, and I'm not going to say it's tragic, and I'm not going to say that it's not going to be challenging, but it's not going to be as daunting as it was a year ago when it just hit us, very quickly.
And I can jump in on the economic perspective. We kind of saw some of this in Europe. If you looked at the fourth quarter of 2020, they did have some of the pickup in the variants, and it will depend on a combination of how states and the federal government reacts to any type of potential pickup in the virus. But in Europe, they reacted by really raising restrictions, and that pushed their economy into a contraction in the fourth quarter as well. Whereas, our country, for example, continued to grow despite slowly, but did grow in the fourth quarter. So I think it will really be a combination of how do governments react, how do people react, do they curtail their behavior, and some of it, but we have seen the impacts if people do scale back their spending and their trips outdoors, and governments combined with that increase their restrictions. And we saw a bit of it here as well. We did have slower spending from the consumer side of things. And so I think that will really determine what happens in terms of economic growth.
From a real estate standpoint, I don't think we're going to change much. We're going to continue to have people working from home. Closings will continue to go on. It will be interesting what they'll do with the mortgage rates, long-term rates. But I think if there's a third wave, God forbid, hopefully that doesn't happen, we'll be able to get through this from a real estate standpoint.
Thank you all. Next question I have is, my business facilitates businesses and offices to open safely without chemicals. We're going into schools and government in the state of New Jersey. Is there a way to get help to secure government contracts outside of the state of New Jersey?
So I'd like to hit that first. So we have skills, we have experts in the contracting industry to actually help exactly with that. So we don't typically work with just New Jersey contracts. It's federal contracts, it's national contracts, it's even international, and potentially could happen, and there's opportunities there. So no, again, we have contract experts that can help look for different opportunities. And again, we assist in this process. We don't find them for them, but we can help them with setting themselves up in a right placement to be eligible from these, what they're looking for, who's looking at the contracts, where to find them. So we have experts in that particular area, both on state contracts, federal contracts, and also private sector contracts as well.
Thank you, Kelly.
And at no cost. So can I say that enough? We're no cost.
Can I ask Kelly, how do you access the New Jersey Small Business Development Centers?
Yeah, so go to njsbdc.com, and hopefully that could be put someplace. You just click on that goes to our website, and you go under the counseling tab and request for consulting. You'll be set up into the system, and then we'll get you aligned with the right center based on where your business is located. And then we'll also find the right, depending on what you're looking for, we'll get you the right consultant with the right skill set to help you. It's very simple.
Thank you. Paging through the chat here to see if I missed any questions or any portions of a question. It looks like I may have missed the following portion, which was a two-part question about the government stimulus packages. The first part of the question was, what exclusions from GDP are there, and do you believe they should be added?
I can try and answer that question. It's a good question. GDP, which again measures kind of the total output of our economy, is not a perfect measure for sure. I think one of the most glaring and most probably debated areas of the economy that aren't fully captured, and they're trying to figure out how to fully capture it, is the technology sector. And it is largely because when you think about, the value of, say, Google search or, your email, for example, that those are not captured in GDP because GDP captures what you pay for a good or service. And so that is something that is widely debated. There have been studies that have been done to kind of estimate how much a person would pay. I think it's something like, $3,600 a year that an individual in some of these surveys would say they would pay for, access to apps like, Waze or Google Maps, something on the order of like maybe close to $1,800 a year for Google search. And so, when you realize, if you think about the number of people that actually utilize these services and would be willing to pay for them but aren't, those numbers are pretty staggering when you think about what might be missing from GDP. So that is something that the Bureau of Economic Analysis, which compiles these statistics, is trying to work on. It's kind of a work in progress, but it is one of the reasons as well that there are arguments that maybe our productivity numbers aren't as high as in the actual statistics as we see them, as they actually are, because we're just not capturing these statistics correctly. So hopefully that helps.
Thank you. And while I have you, one more question. What are the potential implications of the massive financial stimulus on the economy, short-term and or long-term?
Sorry, I missed what you said. What are the impacts of the
massive financial stimulus that's been received to date?
Got it. In terms of the impact on the economy, I think we've seen very direct impacts on consumer spending, and the recovery that we've seen so far has been actually pretty remarkable in that I think it surprised most of us in terms of how quickly the economy bounced back. And that was largely due to the bridge that was provided by this fiscal stimulus. I mean, we'd had massive amounts in terms of the direct checks that were sent out to people back in to lower income households back in April, and then again in December. And you see a very direct correlation with those stimulus direct checks and the unemployment checks as well being sent out, and consumer spending. So retail sales, we had retail sales today, for example, and you actually had a pullback because January was such a strong month for retail sales, right as those stimulus checks were distributed. So I think that's one of the biggest impacts, that it has sustained consumer spending despite the level of unemployment that we have right now. And that has really been crucial in kind of providing that bridge and hoping that we get to the other side where those parts of the economy where people have lost their jobs will be able to, regain their jobs, and we can avoid as much permanent scarring in the economy as possible. I think the other thing longer term, as we talked about before, is that we may have to pay for this, in terms of eventual slower growth because of higher taxes to kind of pay for some of this stimulus that we've put in place. And then I think the last thing in terms of to think about is potential for inflation. This stimulus was much more massive in terms of size, but also different in terms of the type of stimulus that came out, more flowing directly to the consumer, directly into consumer wallets, basically, or their checking accounts. And so there's a lot of money in the system that has not been able to be spent because the services sector hasn't been fully open. And there is some, we do expect that inflation will pick up in the near term, especially as everyone's trying to book their vacations and whatnot. But we expect it to pull back somewhat, but there is some risk that there is a lot of money in the system and that there could be a more sustained pickup in inflation. So that's another potential impact to watch out for, and that could make the Fed have to raise rates sooner than expected. So we'll have to watch it. It will be a balancing act for the Fed. They are trying to boost inflation, so it's one of their goals, but they'll really have to balance that with longer term inflation expectations and keeping those muted.
Thank you. In terms of energy use outlook, how do you think the solar industry will impact different communities and industries post-COVID?
I'll be glad to just try to throw something out there. AT&T has committed to become carbon neutral by 2035. And so among, a big part of that is how we support renewable energy and entering into power agreements for renewable energy so that we can reduce our carbon footprint. So I know we did a large wind energy deal recently, and I got to think that all sorts of renewables would be part of that portfolio as we look to that. You can imagine how much energy our company uses, and going carbon neutral is going to involve a lot of different opportunities, I guess. So
with regards to the small business side of things, any new industry that's going to pop up, there's going to also need support. So what we would look at is that although, shifting over to solar, there's going to be also other opportunities for small businesses to step up and new opportunities for businesses to get into that sector. And so what we would look at doing is, depending on how that all of it rolls into switching over to solar, what are the support, what are the businesses that are needed in the expertise, in the types of skills that are needed to support that industry. So with any other new industries popping up, you're going to find the need of support, and small businesses will rally around that. Because I'll just say, you know, and again, SBA size standard is 500 less employees. Our sweet spot is really 20 or less employees that we work with, but those are the businesses that can pivot based on the upcoming industries that are looking to be in the growth sector. And so as that industry grows, you're going to find more businesses shifting over to provide support in those particular industry clusters. And so we're excited about that opportunity to, again, to help the businesses to shift into that direction, to help in whatever industry it is. And again, there's going to be opportunities that are going to pop up with that.
Thank you, Joe and Kelly. I think it looks like it's time to wrap up. We're at 11:45. So I'd like to once again thank all of our panelists for sharing your insights today. I would also like to thank the Chamber and Rutgers for sponsoring the program with Plaster Greenberg. We look forward to seeing everyone at our next Outlook, and I hope that everyone has a great day.
Thank you so much, Michelle.
Thank you, everybody.
And thank you to our panel for joining us today and providing your insights on the current state of the economy and where we are headed. I would like to once again thank our series sponsor, Plaster Greenberg, and Rutgers University for your partnership on these important events. Just a quick reminder to our attendees that you will receive an email from the Chamber later today with a recording of the session as well as a survey. Please take a few minutes to provide your feedback on this session. Additionally, we will include the link that Kelly mentioned for the SBDC's website so you can get more information from them. Thank you all again for joining us and have a great day. Be well.
Thank you, everybody. Stay safe.